look, earnings are going to be cut dramatically right now. And I just want you to think about this logically for the moment. So Standard & Poor's is the company that runs the S&P 500 index. They update their earnings estimates for the S&P 500. Their earnings estimates, they're saying between quarter four of 2019, which was our last economically viable point for earnings, we kind of knew what was going on in the economy to some degree, was $132.90 a share. They're saying that earnings will only fall to $125 in earnings in the second quarter of 2020. Now, we've shut down the entire economy, and we're only going to have earnings decline by 10%. That's not even close to realistic. In 2008, when we didn't shut down the economy, earnings fell by 89%. We went from $80 a share to $8. So, and that was without shutting down the economy. That was just a major recession, right?
I mean, you can use simple math to figure out something's not right.
Yeah. So that's the point. That's not factored into prices yet, right? We're down 12%, 13% for the year from the highs. You have not factored in a 50% decline in earnings yet. Debt is an erosion to economic growth because if I have debt, it deters whatever income I have coming in goes out to pay the interest on the debt. I can't create economic growth if I'm supporting debt. And so when we went from $9 trillion in debt to $18 trillion in debt, we slowed economic growth because we're spending more on social welfare and we're spending more on debt service payments, et cetera. 96% of all our tax revenue prior to this economic recession went to support just Social Security, Medicare, Medicaid, prescription drug benefits, and interest on the debt. Everything else was paid for through debt. Defense, education, all that type of stuff. Now, coming in this recession and coming out of it, all of our, and considering that tax revenue is going to drop sharply for the government, we're going to require more than 100% just to support social welfare, period. Everything else, including interest on the debt, is going to come out of deficits. More debts, more deficits, you're going to have lower rates of economic prosperity. But starting in 2008, we've decided that we can no longer allow capitalism to function in its normal form. We don't want to put up with pain. And a lot of this has to do, of course, with the government now being pretty much funded by corporations. There's the old joke that congressmen should have to wear jackets with their sponsors on it. And maybe that's not such a bad idea to know actually who you're voting for, because what we've seen over the course of the last decade is the repeated events where corporations do things to benefit their executives, their shareholders, and they do it without regard to the financial responsibility. So when they get themselves into trouble, they run to the government, they ask for a bailout, and it's given to them. We taught them that in 2008. Bailing out energy companies is not a great idea because we need to have this process occur in the energy sector to weed out the weak players and to reduce this oversupply of oil through a natural basis of just having energy drillers default and eventually just go away, as they should anyway.
This is the fault to some degree of the Fed and government policy, because this should have been going on for the last 10 years. Because when you look at Saudi Arabia, Russia, and U.S. shale, specifically speaking of shale oil, because that's where the marginal oil is really coming from. The U.S. is the highest cost producer by far of those three. There's very few shale wells that can produce for under $30 a barrel, but Saudi Arabia and Russia can produce well under $30 a barrel. So as oil was coming down through the 50s and 40s, the shale is not profitable. They should have been either not exploring for new shale or at least cutting it off and saving it for when the price is back above their cost of operating, and then we'd have oil in the future. But because debt was so easy to get, because private equity was so interested in levering up and trying to show some kind of gains and attracting money because you earn 1% in treasury bonds and you can't go anywhere with that, there was just an explosion of shale exploration. Now we're left with the remains of that, and the question is, do you let it fail or do you resurrect it? And if you resurrect it, you're not getting rid of this supply problem, and it's a supply problem with oil that's unprofitable, that's negative profit. It's costing us money as an economy to get it out and sell it.
Right across from the bank was this massive gully formed by fast running water. And over this gully with fast running water, called the ditch, was a restaurant called El Arroyo.
Ah.
A Mexican restaurant. So we used to eat there literally like every day for lunch. It was like we went across the street, ate at this restaurant. And actually every day what El Arroyo would have out in front was their sign. They'd always have like funny sayings on their sign.
Yes.
Right? So the one they actually had is, in 20 years, our country will be run by people homeschooled by day drinkers.
Truth.
Which is, I know, there's homeschoolers all over America going, I had to expel both my kids for fighting today. You know, that type of stuff. There's homeschool's taking on a whole new meaning now.
You know what? There's a brand new appreciation for school teachers.
Oh yeah, absolutely. Who's actually been found to have more value than football players? Healthcare workers.
Nurses.
Nurses.
Yeah.
Exactly. All of a sudden, it's like, man, we don't pay these people near enough for what they do.
That's true.
And it's true. Look, teachers, it's always amazing to me. You can't have a football player, you can't have a nurse, you can't have a doctor, can't have a surgeon without a teacher. And we pay them the least. Mm-hmm. Makes no sense. And you'd also get better quality teachers if you paid them more. Just saying.
Just saying.
Just saying.